Raghuram Rajan there on a conference call. Let's quickly tune in to say what he's saying.
There are a number of transfers that have been made to the states, which may alleviate some of the state financial constraints. So, as we have said, there are a number of intents which could result in a higher quality sort of consolidation process than in the headline numbers, and that's one reason for some confidence that was expressed in the statement.
Thank you, Governor.
Thank you. Our next question is from Kumar Rajapudi of ANZ Bank. Please go ahead.
Thank you for the opportunity. Sir, anecdotal evidence actually indicates that the past rate cut has not been passed on, with some news reports actually indicating that only 3 out of 45 banks have lowered their base rates. Are you concerned about this, and is the RBI trying to take any measures? And in fact, if you look at the Urjit Patel Committee's recommendations, there was a specific line which said in a rate cut cycle, the transmission best works in a accommodative liquidity stance. So I just want to know your elaborated thoughts on this.
Well, the liquidity stance has been fairly accommodative, but also I think that what happens is the process of transmission is somewhat asymmetric, that banks tend to be a little faster in raising rates rather than in cutting rates. I have no doubt that the pressure of these two rate cuts over time will feed into lower rates. But we're also examining whether there are any institutional constraints in passing on these rate cuts. We, as you know, have made changes to the base rate determination policy, and we will be examining this very carefully to understand whether it is working as effectively as it should. So my hope is that over the span of the next few weeks, remember March is typically a time when banks try and hold liquidity. But as we move into the new fiscal year, we will see more transmission into lower interest rates.
Thank you, sir.
Thank you. Before we take our next question, we would like to remind participants to ask a question, you may press star and 1. Our next question is from Devika Mendiratta of ANZ. Please go ahead.
Good afternoon, Dr. Rajan. I just wanted to understand that at last month's policy, the inflation statement said that in January 2016, inflation was likely around 6%, whereas today you indicated that at below 6%. What has led to that small increased comfort that you seem to have on inflation? Thank you.
Let me ask Michael Patra to answer that.
The Central Statistics Organization has just posted on its website granular details on the CPI and their methodological note. Together with this, it's just that going forward, inflation might trend a little lower than the headline that we have today because of methodological improvements and also coverage.
Also remember that after our last statement, we've had at least one inflation reading, which helped us make this determination.
Thank you so much. Thanks.
Thank you. Our next question is from Raghavan MJ of SBI Life Insurance. Please go ahead.
Good afternoon, Governor. We read the documents of the previous policy quite carefully, and this kind of a move was definitely factored in post the budget. But if I'm not wrong, there was a speech which was in the public domain a couple of days ago, where there was a mention that the RBI will not be very comfortable doing too many rate cuts based on inflation trajectory. And that kind of put the market participants in a different tone of expectations altogether. So I would want to know what was the intention that you were trying to tell during that particular interview, or did we read it wrong? And this question is...
Let me answer this first. this comes from paying attention to closed-door meetings which should not have been reported outside. I apologize to the wider public, but there were no reporters supposed to be present. This was a direct interaction with students. And the context was very clear. I was talking about the fact that internationally, central banks, especially in developed countries, had brought interest rates down to zero, and it was very hard for us to follow because we had higher inflation. It was not a commentary on, whether we would, if you read the statement fully, it's we will not be able to cut rates quickly to the bone, which means down to zero. Nowhere are we talking about cutting rates to that level. So I don't think there was any misleading of the markets. But I apologize. This was a closed-door meeting. You should have seen the full context of what was discussed then. You would have realized I'm not talking about our current inflationary path and our current monetary policy. It's more talking about the general sense in which we could not match the industrial countries. So, unfortunately, when these half-baked newspaper reports come out, it does mislead market participants. But this was a closed-door event with absolutely no reporting supposed to be done. And I'm afraid that when people violate the rules, these things happen.
Thank you, sir. And my second question is, though you have a technical committee, monetary committee, where you release the actual the voting of the members within that, for such a inter-meeting move, can the market be made aware of what was if at all there was a voting, or what was the majority of votes that wanted a rate cut? And going forward, if the MPC is actually implemented, what would be the conditions under that? Will there be inter-meeting cuts during that also, or is it going to be strictly only during meetings?
So let us wait for an MPC to be created before we decide when it will meet. So the Technical Advisory Committee is an advisory committee, and it does give us advice before monetary policy meetings, sometimes through a physical meeting, sometimes through an email discussion. At times when we feel the need to move, simply because we have had a substantial accumulation of data, and for a variety of reasons that I have stated in the policy statement, we don't consult the Technical Advisory Committee. We move on our own at that point.
Thank you, sir.
Thank you. Our next question is from Parimal Heda of Bajaj Allianz Life Insurance. Please go ahead.
Dr. Rajan, when we read today's policy statement, it says that strong rupee is undesirable, and on the other side, we also see that RBI does not target a level of the exchange rate, which creates a confusion. Means are we targeting a rupee level, which creates a discretionary impulse, and we are trying to go the same path like other countries to ensure a competitive depreciation of rupee?
No, we're not doing that. First, I said an excessively strong rupee is undesirable, which you'll agree, I'm sure, with. That's a statement that it's very hard for anybody to disagree with. The fact that it's undesirable doesn't mean that we necessarily will act against that if that situation were to arise. Because I believe that what we can do is perhaps act against temporary undesirable volatility. But it's very hard for us to act on a sustained basis to maintain a value of the rupee. And so we've said time and again that our intervention, which is typically both sides, is to reduce volatility that we think is avoidable, but not really to create or maintain a desired value for the rupee. If the rupee attains a value, and I'm not saying it has that value today, but if it does attain a value which is undesirable, it's not clear, and I don't want to say more, that in fact we can do a whole lot against a level if that is what the market in its full wisdom, with all the players participating, believes is the level.
Thank you.
Thank you. Next question is from Asta Gudwani of Birla Sun Life. Please go ahead.
Thank you so much for the opportunity, sir. Two questions. you suggested that it is appropriate, the intermeeting policy move should be read as a guidance on how would you implement the monetary policy framework. If you could just explain, because the operating procedure of monetary policy under the MPFA is not very clear to the general audience at large. So how do we read the intermeeting policy as a guidance to that? The second one is, since after taking into account the revision of CPI base, you have a fresh trajectory of CPI in your mind, basis which you have preempted the monetary policy easing, as mentioned in the statement today. Going forward, further monetary policy accommodation, is it correct to assess that it will be based on anything which gets more weightage than CPI? Example, the things that you have mentioned with respect to supply augmentation, which should come on surface. Thank you.
Michael, would you like to answer?
On how we will implement the new monetary policy framework, remember that we are moving to what has been described as flexible inflation targeting, and this requires a nominal anchor. So the nominal anchors for the years 15, 16, and thereafter have been very clearly set out in this policy statement. The other thing that has been set out is that we will strive for the midpoint of that range, and only over a 2-year period. That will give us time to ensure a gradual disinflation while minimizing the output costs. That, I thought, is the cornerstone of this new monetary policy framework. On the CPI, essentially the timing of monetary policy moves will depend on these incoming data, which will enable and provide headroom for monetary policy to work in its stated stance. And these are the things we will look forward to.
There is an additional question, a time frame for inflation target to be achieved. This is from Venkatesh of JP Morgan. He is asking, there is a reference to the policy. He says, going forward, the RBI will seek to bring the inflation rate to the midpoint of the band of 4% plus or minus 2. By the end of a 2-year period starting fiscal year 2016-17. He wants clarity on that period, the fiscal 2016-17. Does it mean 2 years after that or including that?
About 2 years after January 2016 effectively. So by the end of
January 2018.
January 2018, by that time we should have reached the midpoint of the band.
We'll take the next question.
Thank you. Our next question is from Saurabh Gogri of ICICI Bank. Please go ahead.
The question is regarding the liquidity management operations. While you continue to mention that you will continue to provide liquidity of 0.25% through LAF and 0.75% through term repo, we see that the systemic liquidity deficit has come down significantly on account of RBI actions in the forex market. Could you throw some light on what is the targeted deficit level in the system now, or RBI is open to moving system to a surplus mode and keeping the operative rate at the repo rate through variable reverse repo?
Well, I think the way we think of it is to separate liquidity into two components. One is really what we would call permanent liquidity, which is the rate at which we expand the sum of our domestic bonds plus foreign assets. And that we think is more permanent assets that we are buying, financed by permanent liquidity provision into the market. We want to grow that at a rate which is consistent with our inflation forecasts as well as real growth of the economy. Now, the second element is temporary shortages of liquidity, which emerge from things like government payments, government balances, etc., which change over time. And we try, and seasonal factors, festivals, things like that. And we try and accommodate that through the short-term repos, overnight repos, term repos, and so on. So you know that in March there is usually some tightness as banks accumulate, stop lending to one another, accumulate reserves and so on. And so at such times we tend to provide more short-term liquidity, knowing that there will be large reversals at the end of the month. So that is broadly our strategy. I hope I've answered your question.
Yeah, thank you, sir.
Thank you. Next question is from Nirmal Gandhi of SBI Life Insurance. Please go ahead. There seems to be no response. We'll take our next question from Rohit Arora of Barclays. Please go ahead.
Hi, good afternoon, sir. So in today's statement, there was a mention that the RBI seeks to bring the CPI rate to the midpoint of 4% by the beginning of FY19. So I have two questions on this. One is, given the volatile components in the CPI basket, how much government support would this require? And second, what in RBI's view is a sustainable equilibrium nominal and real rate for India's economy?
Look, I think as far as how much support will be required, only time will tell, right? I mean, I can't tell you right now. But I do think you should take comfort from the willingness of the government to go into this inflation targeting framework as a partner in some sense, or as the way we look at it is we get our orders on the framework from the elected representatives of the people who are represented by the government. So in that sense, that is our framework, and the government, of course, has to be supportive in this process, and it has been in the past. What was the second question?
So it was what, in RBI's view, is a sustainable equilibrium nominal and real rate for India's economy?
Well, the way we think about this 4% midpoint is really, if you look at the industrial countries, they are seeking, for the most part, a 2% nominal interest rate. And if we say on top of that we have a 2% productivity advantage as we catch up in growth, then a 4% inflation rate on our side would tend to keep our nominal exchange rate, that is including Balassa-Samuelson effects, at pretty much a level vis-a-vis industrial countries. So that is really the thinking behind why 4%. It's also something that previous committees that have gone into this in great detail, for example, the Sukumar Chakravarti committee, have suggested. All these sort of suggest 4 may be a comfortable level for India to try to reach, but also given that this is a process that is starting, we have somewhat wide bands around it. My belief is as we get more comfortable, and I'm talking in the 5 to 10 years scenario, these bands could tighten. But for now, we think these are appropriate. As far as the level of the real rate goes, I've said repeatedly at this point in the cycle, 1.5 to 2 real is probably appropriate.
Next question.
Sure.
Our next question is from Sudhir Agarwal of UTI Mutual Fund. Please go ahead. Mr. Sudhir Agarwal, your line is unmuted. Please go ahead. There seems to be...
Hello?
Yeah. Go ahead, sir.
Yeah. So I wanted to know this, the latest fiscal deficit, if you look at the consolidation, has been to the extent of just 11 basis points from 405 to 3.94, right? So is it that now the RBI is looking at the quality of the consolidation rather than looking at the quantum of consolidation? Or is it that the CPI disinflation was so high that RBI has chosen to look at that only?
Look, I think the statement that we've issued makes it clear that there's a possibility that the actual fiscal consolidation could be higher than the numbers that you just mentioned. But also, we have emphasized the quality of fiscal consolidation, the emphasis on investment rather than substantially more consumption expenditure. Of course, people will toil through the budget and look for various aspects of it. Our point is this is a reasonable place for us to for it to meet the conditions we had set in our earlier statement about seeing higher quality fiscal consolidation. But we also emphasized that more work needs to be done as implementation takes place. And therefore, and that work is not just the central government, it's also the state governments, because there's been so much devolution to the states. So this is work in progress, and we will be watching the progress.
Thank you.
Our next question is from Prithviraj Datta of Edelweiss. Please go ahead.
Hi, good afternoon. Actually, my question is that in the union budget, we saw that there was some provision for setting up of a public debt management agency. So my question is, what would be its function, and how would it be different from the issuance department of the RBI? What would be its objective, basically?
I think this is a question you should ask the government, not us. It is an agency which has been mooted for some time by the FSLRC report, and I think the government has expressed an intent to bring it about. I think as of now, this is just an enabling clause. We have to see what precise form the agency takes. My sense is when it finally emerges, it will have a lot of RBI presence and support to avoid reinventing the wheel. But there is still a long time to go before the precise form. There is a task force which is out there, which is formulating the structure of this agency. So I think we're at least a year or two away from more details.
All right. Thank you.